afternoon. We're here today to give you our analysis of the hotel industry for Finance 370. My name is Zachary Wood.
I'm Brandon Bingle.
I'm Brandon Owens.
I'm Cole Fabio.
To get us going, we've provided a brief agenda. We're going to start off with the industry overview, give you a broad general idea of the hotels that we're going to be covering. Then we're going to follow it with the individual company introductions, where we'll get into what each of our companies does specifically, and then we're going to provide a collective analysis of the profitability analysis, working capital, equity analysis, cost of capital, and company valuation, and then we're going to end it with our recommendation from each analysis.
The hotel industry is a part of the consumer discretionary sector. So overall, this means that it's companies that produce non-essential goods and customers tend to buy with discretion when they have available income. Prices are very elastic, and when you are in this sector, you usually follow the trends of the economy. So if there's a recession, your companies tend to do bad, and vice versa. Overall, in the hotel industry, consumer confidence throughout the world has increased, and that has caused travel to increase. So that means these companies, like hotel companies, are doing very well as of right now. There's been higher demand and increased consumer spending in luxuries, and emerging economies in certain countries, third world countries, have a great opportunity to have hotels in them. And the industry revenue grew by 3.4% last year. These are the 4 hotels that we analyzed throughout the semester. We had Wyndham, Marriott, Hilton, and Hyatt, and we consider these the top 4 competitors in the industry.
Now we're going to get into each of our own companies that we analyzed. To start off with, I did Marriott International. It has a ticker symbol MAR. It was established in 1927, so that goes to show you that they continually had success decade after decade to build their brand. As of right now, they operate 4,424 properties where are found in 85 countries around the world. The average growth of number of properties has increased each year, and they've actually seen an average of 4.46% each year. And they actually have 19 hotel brands, which they franchise out to other investors who are interested in owning the Marriott brand because they know how successful and loyal they are. Some hotel names or brands that you might know of are the Ritz-Carlton, Spring Hill Suites, Renaissance Hotels, and the Courtyard. In the last year end, they reached $14.5 billion in revenue, which is one of the highest compared to the other hotels in the industry. And recently, since we've calculated all our 10Ks and valuations, they actually acquired Starwood Hotels, which goes to which they aim to complete their luxury portfolio. And that deal was closed for $12.2 billion, and it was actually a stock and cash deal, mostly stock though. And some historical prices to give you an overview of Marriott. That IPO in 1998, which is a long time after, obviously, they established it in 1927. The IPO was released at $36.88. And February 5th, 2016, when we took all of our 10Ks, which were released in February, the stock price was around $60. And on May 13th, when we all finalized and put together the presentation, the stock was at $66.88.
I worked on Hilton throughout the semester. The ticker is HLT. It was founded in 1913. It has over 4,000 properties and over 57,000 employees. One huge part of Hilton is that it's represented in 98 countries throughout the world. It was purchased by Blackstone Group in 2007 because Hilton was going through some financial problems. And on December 11, 2013, Hilton initiated its IPO 100 years after they were founded. Their major competitors are, as we said earlier, Marriott, Hyatt, Wyndham, and Intercontinental Hotels. As from the last 10K, their revenue was $11,272 million, and their stock price currently is $22.03.
So next, I've been working on the Wyndham Worldwide Corporation. The ticker symbol is WYN. They were founded in 2006. When I say founded, they weren't exactly created then, but they separated from the Ascendant Corporation in 2006. As of today, they have over 7,800 properties in 70 different countries. Not only is it the largest property wise in the industry for a hotel corporation, but it is also the leader in the vacation exchange network, which is things like timeshares and international travel accommodations. Just a quick stock price history for Wyndham. The IPO was set in 2006 at $32.50. Just 5 years later, after the first 5 years, it got to $34 and just about 60 cents, which was only up $2. And that brings us to today. Another 5 years after that, it is right around $67. And the main competitors are Hyatt, Hilton, and Marriott.
So I analyzed the company Hyatt. It's not nearly as large as Hilton, Marriott, or Wyndham, but it is a company that's looking to expand. They're new. They were founded by Jay Pritzker in 1957, and their IPO was in November of 2009, set at a price of $25, and it had 38 million outstanding shares. As of May 2016, the stock prices are just under $48 and has 134 million outstanding shares. Hyatt Hotels Corporation has 599 properties with nearly 100,000 employees, and is represented in 52 countries. Under the Hyatt Hotels Corporation, there are 6 brand names. There's Park Hyatt, Grand Hyatt, Andaz, Hyatt Regency, Hyatt Centric, which was the newest one in 2015, and Hyatt Hotels.
To get us going a little further in comparison to a broad overview of each of our hotels, we're going to go with our strategic analysis. To begin with Marriott, my company. Most companies that they have a mission statement, but instead Marriott has a vision statement, and that's where they quote unquote aim to be the #1 hospitality company in the world. They're very goal orientated, and each year they set goals to reach, like say acquire a certain number of properties or employ a certain number of people. Currently, one of their strong points is that they have 55 million member successful Marriott reward program. And that is important because they've grasped an extremely large market share, and they get their loyal travelers to come back and stay with them every time. Another thing is their multi-brand strategy. Like I said, they have 19 brands, and each brand aims at a different consumer. You have your luxury resorts, and then you just have your basic inns where you might stay at on the highway, but they cover all accommodations. And there's also endless mergers and acquisitions available to them due to their amount of capital that they have on hand. And that's due to just like the increase in global commerce and international business where people are traveling at endless occasions.
For the strategic analysis for Hilton, Hilton has already established itself as a well-developed brand in this industry, but at this point, with the new development of technology, that's where Hilton really wants to separate themselves. They have uses of new technology in check-in and check-out, also with customization overall for customers to have the best experience and the best satisfaction, and that is their #1 goal. Also, they are represented in 98 countries, as I said earlier before, and that gives them a great advantage to house customers wherever they want to travel, and customers will be loyal to Hilton because they are represented throughout the world.
As for Wyndham, like pretty much any other hotel in the industry, their goal is to give their guests a very extraordinary experience with every stay, whether it's internationally or domestically in the United States. One thing they're doing strategically going forward is they just set out a new member loyalty program where before there was kind of a scale for how many points they needed to get a free night at each level tier of hotel, from the lower economy level hotels to the upscale hotels. And now Wyndham as a company has just set a flat rate of 15,000 points for any tier level for a free night at their hotel. And another thing that is added on to this loyalty program is that the guests can now book rooms with points that is below the 15,000 limit, and they can make up the difference in the cash, whereas before they would have to just either use all 15,000 points or pay all the cash. And Wyndham as a whole has the highest return rate from the rewards program in the industry.
For Hyatt Hotels, their number one strategic analysis goal is to cultivate the best people and evolve the culture. This being said, they focus on attracting, developing, and rewarding individuals with the success of the company. Diverse individuals to be employed for each property owned by Hyatt is very important. They want to reward these individuals that perform above the normal, and they want to allow them to continue to grow the company and be happy with it. They don't, with being in 52 different countries, they like to get diverse people, not just stick with like the locals. So they'll bring people around internationally from all over the world, and they'll have them work at their companies to try and increase guest services, hotel services, and just to try and separate themselves from the company, the competitors, in order to get that guest loyalty.
All right, so next we're going to transition into the analysis part of our presentation. I'm going to start out with the profitability analysis of all four of our companies separately. The chart on the left shows the total revenue of all four companies and the industry as well. You can see from the numbers that all of the companies are increasing their total revenue year by year. For the most recent year, Marriott is a leader in total revenue with about over $14 billion. Second is Hilton with $11 billion, and Wyndham and Hyatt finish off the four. The industry average is about $8 billion, so as you can see, Marriott and Hilton are well above that, where Wyndham and Hyatt are a little still below that by about $3 billion. And on our right here, you can see the gross profit margin and the net profit margin of the industry. And you can see that the gross profit margin is right around 10% for all 5 years, give or take a couple percents. The most recent number we have for 2015 is 13.81% for gross margin. And for net profit, it started out in 2011, the first year that we looked at. It was all the way down to 3%, and coming through the past 4 years, in 2015, it's gotten up to over 9%. So next we're moving on to, we're going to look at the net profits. So on the left is a chart of our four companies and the industry average. You can see the industry average for 2015 is $753 million. As for our four companies, Hilton had the highest net profit of $1.4 billion, and Hyatt had the lowest net profit of only $124 million. Going back to our last slide, Marriott had the highest revenues out of the four companies, and they have the most consistent net profit, but as I said before, it's not the highest, but it's the most consistent. And looking over on the right, the net profit margins, knowing that Marriott had the most revenues and the most consistent net profit, you would think that you would want to invest in them right away. But once you look at the net profit margins in our chart on the right, you'll see that they are not close to being the most efficient company out of the four that we looked at. And they are well below the industry average as well. The industry average is 9.1% for 2015, and Marriott's company is only 5.9%, which is third out of the four companies. All right, so next we're going to look at our efficiency measures. We're going to look at how we analyzed return on assets as well as return on equity. So first, these two measures show how a company utilizes their resources, and it will overall give us a better idea of which companies would be a better investment. So to start with ROA, Marriott outperforms the industry, as you can see by the percentages. They outperform the other three companies because they mostly franchise their brands out to others, so they aren't really using their physical assets. So this also goes along with the return on equity because Marriott, because they aren't using their physical assets, they have a low amount of equity, which yields a higher ROE. And also Hilton's ROE is very high starting in 2013, and it increases up to 2015 because of their IPO, which they set out in 2013.
The next part of our analysis, we're going to be looking at the working capital, and this gives us a measure of the capital that each company has available to them on a day-to-day basis at hand. And we're going to get into this by looking at the liquidity ratios, which shows how likely a company is to, or their ability to pay back their short and long-term debt. The ratios that we're going to look at are the quick ratio, current ratio, and cash ratio. To begin with the quick ratio, Wyndham is the best performer. The higher the number of the ratio, the more they have ability and the more likely they are to pay back their debt. So Wyndham is the leader there. For the current ratio, Hyatt is the leader, and for the cash ratio, Hilton is the leader. So as you can see, among the industry, each is better at one ratio than the other. Looking at Marriott seems to be the worst performer among the ratios, and that kind of goes along with them not being efficient, like we've already mentioned, due to their profits and even how they've utilized their resources, like return on their assets and their return on their equities.
Okay, when looking at the stock performance of the industry over the past 5 years, you can see that Wyndham at the top of the line has been the most consistent, followed by Marriott, which is just behind them. You can see that in 2016 they are both around 100%, followed by the Dow Jones, which is the red line, at 67.5%, and then the S&P, which then follows with Hyatt and then Hilton.
Now we're going to talk about our cost of capital, or also known as the WACC. You see we have, for each company, we have each individual WACC. The numbers vary, but they're usually around between 3 to 6%. The whole point of the WACC is to compare debt and equity and to see how much compensation the company has to give to each investor. This is Hilton right here. In this case, the market return is 4% and the WACC is 3.6%, which is lower. So in this case, since the return is higher, you would invest in that company because you would receive money back and the company would be gaining money rather than losing money. Now these are the company valuations. We first have the initial stock prices from the valuation and then the current stock prices. Hilton has gone down 2%, but every other company has gone up by a large amount of percentages. We use the dividend discount, market multiples, ROPI, and free cash flow model to find the equity valuations. Hilton was the lowest with their average valuation of $8. The ROPI actually came out to $0, which affected the whole average. But since, like we said earlier, Hilton started their IPO in 2013, so there's not much weight in their stock currently. Marriott is the highest at $82.11, and that's expected with having the highest revenue and being one of the best companies in the business.
Now to conclude with our recommendation of each of our hotels. My company, Marriott, I suggest that you buy and hold a long position on them. I really think they have a bright future as they yield the highest revenues. Over the past few years, they've really increased their efficiency in terms of their margin on net profit, and that's like a huge piece of their future as they've shown growth over the next 5 years. They've projected an increase of 6.88%. Recently, like I mentioned earlier, in April they acquired Starwood Hotels, which really complements and completes their luxury brand to complement their other 19 brands. And lastly, like their successful franchises, all of their brands have been tremendous for them. The cost reimbursed on the revenues is from the franchises, and year in, year out, it's approximately 80%. So that just goes to show you how successful their franchises actually are, and they represent 80% of $14.5 billion. So they've built a brand that people want, and they're going to continue to want, and I really think they're just going to keep growing over the next several years.
As I analyze Hyatt Hotels, I would say that this is a company to invest in. Over the past 5 years, their growth percentage has been around 5% and continues to be around 5% over the next 5 years. The thing that I like most about Hyatt is their priority and expansion. Being one of the smaller companies in the industry and still not too far behind, they have a lot of room to grow, only owning 599 properties. Hyatt has only properties in 52 countries, and they have so much room for expansion and growth in company. I also like how when building resorts, they like to separate themselves not only with employees and guest services, but also just the environment and the feel of the resort or property they're staying in.
Here's Hilton's recommendation. I would invest in Hilton. There's two parts to it. First of all, they've been around for over 100 years now, and they have set a brand legacy that puts them at the top of the industry, and this gives them an advantage, and customers will be loyal to a company like this. It's been around a long time, who's established, but also looking at the numbers, they have great profitability, liquidity, and great leverage ratios, and that means that they are increasing their revenues and also paying back things in time while also having a higher profit and making a lot of money. So I would definitely invest.
So next, for a recommendation for Wyndham, I would definitely invest in Wyndham, as they are the biggest property-wise hotel that we have analyzed in the industry, and that's all while being relatively young to being their own company. Like I said, they went off on their own in 2006, so that's really only 10 years of doing what they've been doing. They're looking to expand internationally, where Marriott and both Marriott and Hilton are over 85 or 90 different countries, where Wyndham's only in 70, so they are looking to expand globally. And looking at the ratios that we've gone over and the profitability, we really see constant growth and stability in Wyndham, which is why I chose the path to investing.
Thank you for hearing our presentation. Any questions?